Hey guys, welcome to the Passive Investing Made Simple YouTube show and podcast. We are here to teach you the ins and outs of passive investing. And so if this is your first time hanging out with us, we do this show live every Tuesday to help you become a more confident passive investor, build your skills. And we spend a lot of time in talking about goals, risk, timeline, and just like how do we underwrite operators, markets, and deals. Today we're going to talk taxes, but before we do that, I just want to encourage you, if you're watching this for the first time, visit passiveinvestingwithwhitney.com. There you're going to be able to get a one-on-one call with me. We can talk about your goals as far as passive investing, and then discuss like how we can help you meet those goals. And so for you again, that website is passiveinvestingwithwhitney.com. Now, also, I encourage everyone listening to this that today we're going to drop the house. We're going to bring the value when it comes to taxes. I got two amazing guests on with us today. So I want you to click follow on passiveinvesting.com's YouTube page or on your favorite podcast player of choice. And I want you to share this episode with every single passive real estate investor that you know. And quite frankly, honestly, every real estate investor you know, right, Amanda? They need to know this information. So she's like nodding her head. So if you're listening, we got a thumbs up from our host. Now, all right, let's dive into today's show. Today, we're talking about kind of the tax wealth playbook. Now, not a whole lot's changed from year to year quite yet, but we'd like to do a recap of what passive investing, all the different tax benefits you can get around passive investing. And I want to bring on two key experts with us here today, Amanda Hahn, Matt MacFarland with Keystone CPA. Matt and Amanda, welcome to the show.
Thanks, Whitney. It's good to be here. Thanks for having us.
Excited to be here.
Absolutely. Well, before we launch into all these questions that I have for you, and then I'm sure that our guests have for you, I would love for you just to give us a little bit of background about who you guys are, what you do, and how on earth did you get into the tax space?
That's a loaded question.
Yes. Well, not only are Matt and I real estate CPAs, but we are also investors, just like many of you guys who are joining us today. So we work with investors all over the US, mainly on how to use real estate to pay less tax. And I'm actually a third generation of real estate investors in my family. I told myself I never wanted to be a real estate investor because my grandparents, growing up with them, they were very hands-on with respect to their rental properties. And it's just not something I wanted to do. But I started my career in one of the big four accounting firms and accidentally ended up in the real estate group and was able to see firsthand sort of the power of real estate investing as a wealth building tool and also as a tax saving strategy. So yeah, I think that's kind of what changed my mind about real estate investing, and we're able to do so passively as well with our own portfolio where I didn't have to be that hands-on landlord that I didn't want to be.
Yeah, and a little glimpse behind the scenes is Amanda and I are married to each other. For those people who might be listening, don't know that. So
because we're making out
before this gets weird, but I got my start in the tax world at a big four accounting firm, same one. This is where we met, obviously. And my big aha moment from real estate was kind of, I don't know, I was probably 25 years old, reviewing individual's tax returns, probably in the 60s. He was retired. All he did was real estate. And you can quickly kind of tell after accounting for the depreciation of his return, this guy was making over six figures in cash flow and not paying any taxes. So that's kind of when the light bulb went off for me. It was like, hey, there's something here. And it was just, understanding it and, kind of being interested in it for sure.
Well, awesome. And a lot of people, when they hear taxes, they run the other direction. I am just so, thankful for you two, like diving in here, supporting not only like all of the people that you support as clients, but just supporting the community and helping them understand how to create, not just save money, but create velocity with, a good tax plan. So let's dive into some questions. Now, I know we have some live listeners here. Guys, I encourage you right now, go to your Q&A box, go to the chat box, drop in those questions. I will field those questions in line in the webinar. Otherwise, we'll stay here towards the end, clean up all those questions in our Q&A section. But I want to kick it off with some, questions that we get quite regularly from our investors on various webinars and conversations. And the first kind of stems from that a lot of passive investors, when they're looking to invest in a private equity deal, like a multifamily deal, self-storage deal, express car wash deal, they don't really realize that they can get the similar tax benefits of investing in that syndication versus owning the real estate independently. So help us break down why or they think they have to directly own it. So help us break down like why that's not true, and just highlight some of the key advantages and tax benefits that are available both to our active investor, but also the person who has a higher and better use for the time and wants to invest in real estate passively.
Yeah, and I think that's why we love doing what we do in terms of, like you said, just sharing the knowledge of it beyond just with our clients, because this is a common mistake area we see all the time. And I think a lot of our listeners probably have been told this too, that if you are a passive investor in real estate, or real estate is not your full-time gig, basically, right? That there's no tax benefit to you to invest. And when accountants and CPAs say that, what they're doing is they're taking a very tunnel vision look. And all they're saying is maybe you make too much money to have real estate offset taxes from your W-2 income. But the reality is, regardless of whether you're a passive investor in a syndication or you own your own rental properties, all of us are able to use a lot of the same tax benefits so that we could pay less tax on the real estate income that's being generated. So, the most common examples of a real estate specific benefit would be depreciation, right? We get to take a paper loss on the purchase price of the building. So if you have a single family home, maybe on a property you're writing off $3,000, if you're doing a syndication investment, maybe just add a couple zeros to that, right? But the same concept is we can use the same depreciation to offset taxes from the rental income. And I would argue that if I've made more money without paying more taxes, I've effectively saved on taxes, right?
Yeah, because keep in mind, I mean, the syndications, if you're an active investor, you got your own real estate, you're trying to maximize your deductions, you're trying to maximize your depreciation, so you don't have to pay any tax on the cash flow. The syndication is doing the exact same thing for their investors, right? They're trying to figure out what's the maximum depreciation we can take early on to kind of create, be able to give cash flow away to the investors, but not have to pay any tax on it. So we see that all the time, right? Investors are getting K1s and say, hey, you got $20,000 in distributions during the year, but your share of the company's profit is zero, or even a loss for that matter, right? So you've got $20,000 in your pocket, you're not paying any taxes. I mean, that's definitely a win, obviously, as an investor.
Awesome. Okay, so we talked a little bit about depreciation. What are some of those other tax benefits that are available to both the active and passive investor that would be available to both categories? And then how does bonus depreciation play into all this?
Well, I'll answer the bonus depreciation first. So bonus depreciation basically is something that came out a couple years ago, where instead of waiting 5, 7, 15 years to write off certain parts of your real estate investment property, you can do it faster. So a couple years ago, we had 100% bonus depreciation, where if it was a 5-year asset, I didn't have to wait 5 years to equally depreciate it. I could just take all of it up front. So currently this year we're at 40% bonus depreciation. It's a little bit still up in the air whether the new administration is going to change that. There has been signals of bringing it back to 100% bonus, but again, what is it that we don't want to count our chickens before the
Eggs before they're hatched.
Before they're hatched. Okay, yes.
Yeah, you had it right. Don't count the chickens. It's the chickens.
I don't know. Is it chickens?
I think it's the chicken.
We'll have to fact check that. We got to write this down. Make sure we get our analogies down before we get on there.
But in any case, it's it's possible that we would have additional bonus depreciation come back. So it's basically taking a tax benefit of investing in real estate and sort of supersizing it, right, by giving you more depreciation benefits earlier rather than having to wait a little bit later.
And I think from like a kind of big picture perspective, whether you're an active investor, you got your own stuff, you're a passive investing in syndications. We talked about using real estate depreciation. I'll kind of offset that income from that exact deal. But keep in mind, you could have maybe you've created a loss on one property or from one syndication. You can use that to offset income from another property or another syndication. So that's a way that investors can kind of leverage existing investments to offset other investments. Maybe you invested in a syndication a couple of years ago that's now cash flowing and now it's got positive income on their tax return. You would be paying tax on that maybe. But if you invest in a new syndication that maybe is doing depreciation or cost seg study, whatever it might be, and creating a loss, those two can offset each other. And it's very similar if you're an active investor too, if you got your own losses to offset your own income from the real estate.
So I think one question, and this is something that I really try to help our listeners understand, is the difference between depreciation and we have the inline depreciation, we have the accelerated depreciation that we get, when we do the cost segregation study and we push things forward. But that there's a difference there. Those, and correct me if I'm wrong, and I would love for you guys to go deeper. The use of depreciation is more of an accounting methodology, whereas the bonus depreciation is more of a tax incentive package, right? So correct me if I'm wrong. This is how I coach people is like, if we do the cost segregation study, we're accelerating as much as we can to the first 5 years of the project, but we have to take it equally over 5 years. But the tax incentive part of this, the bonus depreciation, pushes a lot of it to year one. And so I think when people see the bonus depreciation ticking down, they're thinking, I'm getting less depreciation in real estate. At least those are the conversations I'm having. I'm like, no, like stop.
Yeah.
Right.
It's just the timing difference.
Will you go into that a little bit more?
Yeah, at the end of the day, yes, and we have investors say this too, like, oh my gosh, well, we used to get 100% bonus, now we're at 40%. Does that mean I'm losing out on 60% of my depreciation? And the answer is absolutely not. You still, at the end of the day, you will get all of the full depreciation of your properties. It's just with that tax incentive package, like you were saying, the government was allowing us to supersize it and like get more, much more faster depreciation than we normally could. But even though it has been haircut, we're still getting the same depreciation. We're just going to get it over time rather than all of it upfront immediately. So this is what we call timing difference in the tax rule. Same benefit, but timing wise, when do I get it? How do I get it? And that kind of goes back to the whole concept of, are there tax benefits for passive investors? The answer is yes, there are tax benefits for all real estate investors. It's just a matter of timing. It's a timing difference of when do I get the tax benefit, right? For someone who's maybe active, full-time in real estate, maybe they get it immediately. For someone who's passive, maybe they get it down the road.
What are some of the other benefits that passive investors get, other tax benefits that they get?
Yeah, I think there's so many. Obviously you touched on one earlier, not even a tax benefit, right? Just leveraging other people's expertise and time and energy and what they know how to do. And you can, our clients too, they go, they continue working in their field that they're experts in, right? But yeah, so we're all, we talked about offsetting income from that deal. We talked about offsetting income from another real estate deal. We have clients that are investing passively in real estate, but they also invest passively in other people's businesses. So they might be a doctor in their regular trade, and maybe they've invested in a surgery center that they work at one day a month, but they're a part owner, and so they share in the profits of that business. Well, that business is passive to them, right? So the profits are passive. They've got real estate losses they can use to offset that income, so they're not paying tax on that. So I think that's another way that passive investors can benefit in the right situation.
And I think just kind of fast forward to like the future. So if I'm a passive investor, I have all these losses that are accumulating that I'm not actually using to offset my W-2 income. Well, typically in the future, when the deal exits, there's going to be gain, hopefully, if we did everything right. So there's taxable gain. Now, all of my accumulated losses are freed up to offset or reduce the taxes on the gain. And if we take it a step further and say, let's say you just made a really bad investment deal, it never cash flowed, and we're selling for a loss. Well, guess what? In that worst case scenario, when the asset is sold and the deal is over, those losses are freed up. And so at that time, typically it offsets W-2 and other types of income. So that's why we say there's always a benefit to investing. It's just a timing of when do you get it? What type of income can you use to offset? And that the answer to that differs for every single investor.
Now, is there a time frame around, investing in a deal and then exiting a deal? That somebody has to stay in a deal a particular amount of time in order to hold on to those losses, or do they get to book them, immediately?
The
And
losses are yours.
I think we're talking more about depreciation recapture. Like, how does that come into play here?
Oh.
Well, yeah, depreciation recapture, like, from a 30,000 foot level, right? Somebody buys a property for $500,000. If they get, and that's what we call their basis in the property is, right? If they take $50,000 of depreciation expense on their tax return, now their basis in the property goes from 500 down to 450. So if they sell for anything more than 450, they're going to have gain on sale, right? Now that first, if they sell for, let's say, $550,000, the first $50,000 of the gain would be depreciation recapture. The other 50 is kind of from appreciation, right? So that depreciation recapture can be taxed slightly differently than regular capital gains. Might be at 25%. Sometimes it's at ordinary income rates. So to your question, Whitney, kind of the longer you hold the asset, the less concern from the depreciation recapture from like being taxed at ordinary income rates. So there's no perfect answer, obviously, but the longer the better, obviously, right? I don't know if you can think of something else, but
yeah. So what I hear you say is, the idea is to hold the property for a period of time to avoid the recapture if you can, or significantly reduce it. So don't
minimize the burden from it for sure.
And also
now,
in syndication investments, obviously if you have your own rental property, you could always 1031 exchange so that you avoid the depreciation recapture. Because if you're meeting all the requirements for a 1031, you just continue to defer it. And maybe if you defer it until death, you get a step-up basis, nobody pays the taxes. In a syndication environment, it's more rare for us to see the 1031 exchange. It's, obviously it's possible, you can do it, but it's probably more rare than the norm. And that's where the offset strategy comes in. It's what kind of, we call that the lazy 1031. So whereas you exit one deal and there is depreciation recapture, but you have another deal that you've invested in that's kicking off losses, they can offset each other. So at least on the tax return, there's not really that big tax bite that you feel, right? Because there is an offset hidden that's meeting that recapture tax.
And does that all have to be done in the same year, or is there a way for an investor to do it in 2 different years, or build up a reserve of losses, in case they want to exit a deal?
Yeah, that's a great question. So let's say I invested in the syndication number 1, it's been building up losses over the years. And this year I sell syndication number 2, I can use all those built up losses from that first syndication to offset the gain this year. So from that perspective, it doesn't have to happen in the same year. But let's say the other examples, I don't have built up losses because I've used them all and I just happen to sell something for a gain. Then yes, I do have to make sure I create a loss this year through other investments in order to offset the gain that I have.
Which is kind of that lazy 1031 that she was referring to, right?
Awesome. I want to switch gears just a little bit, because I think, at least in some of the conversations that I'm having with passive investors, they're trying to figure out how to invest through their retirement accounts. And so I think a lot of people don't realize that they can actually do that. So walk us through how somebody might be able to invest through like a self-directed IRA or solo 401k, and how that works for real estate investments, and even like take it one step further, like how are the taxes handled there?
Yeah, I mean, we love this topic. We've talked 8 hours before on using retirement money for real estate. A lot of our clients do it because obviously they understand real estate, right? So when we talk to clients, it's kind of like, well, what is your retirement account investing in right now, right? And this usual stuff: stocks, bonds, mutual funds. Most people don't have an understanding of that. They obviously have no control over it, and they are hands-on real estate investors. They want to kind of, be able to kind of almost touch and feel control the stuff. So for them, it makes sense to, instead of using their retirement money or all of it to invest in mutual funds, maybe they invest some of it in real estate. And so a lot of our clients buy rental properties directly owned by their retirement accounts. They buy syndications in their retirement accounts. Maybe they're doing notes, maybe they're lending money, all, kind of runs the whole gamut, right? But to them, again, it's, hey, I think I can make a X return using real estate in my retirement account versus whatever I've been getting in the stock market. Why wouldn't I do that, right?
I think there was a research recently that said over 52% or 53% of Americans have a significant portion of their wealth in retirement accounts. So as a real estate investor, or if you're wanting to build wealth through real estate, I would definitely consider using retirement money for real estate, because you're not just limited to the cash that you have available. We have a lot of clients who are syndicator clients, and I think on average about 25 to 30% of money that is invested in a lot of these private equity syndication deals are also from retirement accounts. So very, very important. The one thing I will say is, if you just go to your custodian and you say, hey, I was on this YouTube and I heard I can do self-directed investing and I would like to move I want to do that. A lot of times like Fidelity or Merrill Lynch, they'll tell you, yeah, you can do that. You can do that with us. But what they're talking about is self-directed investing within their choices of stocks, bonds, and mutual funds. Whereas here, we're talking about a custodian who doesn't give you options. Like you go out and shop for whatever it is you want, like Matt said, property, notes, syndications. So just make sure you're working with a true self-directed custodian and not one of the investment firms that basically sell stocks.
And I think you asked about like the taxes, right? I mean, generally speaking, well, as most people know, when they use their retirement money to invest, it's not taxed right now. You work 401k, it's investing in something that's growing. You're not paying taxes on it, obviously, until you pull the money out down the road. Most of the time, it's very similar when you're using your retirement account to invest in real estate. There's occasions, obviously, if you happen to make profit in your investments inside your retirement account on real estate, if that real estate is leveraged, so you bought it inside your retirement account, you buy a $500,000 property, you put $250,000 down, you get a note for $250 in your retirement account. That's a 50% leverage. If that investment makes money, then 50% of that money could be subject to a tax for your retirement account. But having said that, it's not subject. That doesn't mean shy away from doing it, right? I mean, it goes back to kind of looking at what are you doing right now with your retirement money? What's the rate of return? What's the rate of return going to be on this? Even after, if you have some taxes to figure, what's the rate of return after the tax, and just compare them.
Well, and that's something that I sometimes step in, into conversation with the investors. They're like, oh, I don't want to invest in a private equity deal in my retirement account, especially a traditional retirement account, because I heard I'm going to have to pay this unrelated business income tax, and I could wipe out everything. And I'm like, whoa, hold on. You need to talk to your CPA, first of all, like have them help you calculate this, because what if you got a 20% return on that investment? I mean, it's like, what else are you going to do? Invest in the stock market for 7% return? You're still going to have taxes, or are you going to do like a note income, for like 6 to 8, 10%, which, by the way, we talked about pairing notes with our Roth accounts, which can be really powerful. But I was like, I love the fact, Matt, that you brought that up. It's like, in compared to what? So yes, you might have gotten gross 20% return and paid 2% to tax, but 18% still a heck of a lot better than 8.
Yeah, and the thing to remember too is the reason that happens is the IRS is basically charging you a tax on profits you made with somebody else's money. So that, in my example, that 50% that was your money in the retirement account, you're not paying tax on that right now. You're just paying tax on a portion of it, right? That because you use the bank's money inside your retirement account to do it. But yeah, I mean, it's a great point, Whitney. You look at the numbers. It's not, it doesn't mean run away from it altogether. It's you can still be coming out way ahead.
It's and I just clarify something. That tax we're talking about is when you are using debt to acquire the property. That does not apply if you are the debt. So if I'm a note investor with my IRA or my 401k, I don't have to, I typically don't have to pay this UDFI tax because there's the leverage is me. I am the leverage. I've not leveraged my money, right? So something important. And we love having note investments in retirement accounts because guess what? If you personally or through your regular LLC invest in a note, you're going to pay taxes on the interest income. That's at your highest ordinary tax rate. And guess what? As a note investor, there are no tax deductions typically. I'm not writing off, I'm not going to see the note, right? There's no travel expenses. I'm not going to see the note. I'm not going to rehab the note. There's no depreciation because I don't own the real estate. So because it's high tax and no expenses or depreciation, typically that makes a lot of sense inside an IRA or 401k.
Yeah, thank you for that, clarification. I think I skipped over the tax part when we were with Roth, which is a whole other ball of wax. So help us understand, I think, passive investors probably have some sort of concept now, like, okay, great. Heard Amanda and Matt speak, investing, in some sort of deal, either an equity deal or a debt deal inside my IRA account makes sense. Okay, now there's all these different IRA accounts. How do I choose from a tax perspective which account I should open between like a Roth or traditional or a solo 401k?
Well, I mean, a big part of that is going to depend on how much income you're generating, right? What is your taxable income? Because you might be limited. If you have higher income, maybe you can't contribute directly to a Roth. You can maybe do a backdoor Roth, but you can't make a direct contribution. If you're someone who is also self-employed or has you have an active income outside of your job, then maybe you're eligible for a solo 401k. And what we love about the solo K is compared to a regular IRA, the solo K allows you to contribute more each year into the retirement account, potentially. So more write-offs, more towards retirement. You're allowed to borrow from it in case, I don't know, you have emergencies or you just wanted the cash. You could borrow tax-free, penalty-free. And also when we were talking about that unrelated debt financing tax, that actually does not apply when you have a 401k invest in leveraged real estate. So for a lot of our clients who want to invest in multifamily syndications, one of the first things we look at is, are you eligible for a solo K? Because if you are, then maybe we can invest in leveraged real estate without having to worry about that tax. So it's not a one size fits all. And that's kind of the beauty of tax planning, right? Is you sitting down with your tax advisor and talking to them about what are your investment plans, what are your wealth building plans, and then they can help you put together a plan that says, okay, based on what you're trying to accomplish, here's how you should invest and which bucket of money you should invest based on the deal.
I want to ask a follow-up question there because we get it quite often, especially on these webinars. We're like, okay, out of all these different investments that I can do, which is best to put in my traditional IRA, which are best to put in my Roth, which are best to put, hold in cash. Do you have, is that, I mean, one, I get it. Part of it is tax planning, but is there like a high level preference if somebody could invest in any one of those three buckets? Is there a better match for the investment to the bucket?
Yeah, it's a great question. I mean, I think you're looking at the right way, right? It does take holistic planning, look at the whole picture, right? I mean, sometimes it's helping clients, like maybe they don't even have a Roth yet, but it's like, okay, when's the right time to do a conversion, move money from a pre-tax bucket to a Roth bucket and do it in a tax efficient manner? So that's part of the conversation for sure. I think from our perspective on the Roth side of things, like if you've got, let's say you've got all three buckets, right? You've got the Roth, you've got the traditional, you got money outside the retirement account. Which one's better for the retirement, or which one's better for the cash? Obviously, if it's going to be in the right situation, if you're maybe you're an active investor and you can generate losses on your real estate to offset other taxable income you're getting on your 1040, that might be the time to use your cash to buy real estate directly, and then use your retirement accounts to do something else or lend on real estate. But I think on the Roth side of things, sometimes there's clients that, hey, I'm looking at doing this real estate deal or investing in this deal inside my retirement account. It's expected to have, I don't know, some crazy amount of growth. Well, all things being equal, if that's going to be $500,000, $1 million, whatever the number is, I mean, I'd rather have that be tax-free than tax deferred for 30 or 40 years, right? So I think it kind of comes down to the number sometimes too.
And that was gold in there. Can you dive in a little bit deeper and pick that apart for our listeners that are just like, Matt, I felt like you dropped something here, but I don't know what you just said.
Yeah, I think it's just more of, if you're looking at a deal and whether I should use my traditional IRA that I'm going to grow tax deferred and eventually pay taxes on, or Roth that I never have to pay taxes on, what I would want to know is, what is my expected return on investment? If I think I have an asset that's going to give me 1,000% ROI, I probably want that in my Roth because I don't ever want to pay taxes on it. If it's something just like 5-7% every year, maybe I'm okay with the traditional bucket.
Awesome. And by the way, I asked that hashtag for a friend. All right, well, let's skip ahead and talk about like what you see on the horizon as far as like tax laws, changing this year. What should passive investors be aware, and how can they optimize their tax strategy?
Yeah, I think with the change in administration, obviously it's no surprise that President Trump favors real estate investors, favors business owners, right? So there's a lot of tax law that was put in place 8 or so years ago that, if nothing happens, is going to kind of expire at the end of this year. So kind of this might be our opinion, but I think in the tax world, we're expecting probably some big changes coming up probably in the next 6 to 12 months. I would be shocked if he didn't do something that was, helps the tax code or helps real estate investors, business owners. What that is and when that is kind of the big question mark, right? Like, is it going to bring back bonus depreciation? Is it going to be 100%? Is it going to be retroactive beginning of 2025? Is it maybe to be retroactive 2024 and we'll all have a drink and sell something? I don't know. But yeah, so I think if I was a betting person, I'd say there's going to be some significant changes coming up. And for investors, I think just kind of stay up to date, talk to your tax advisor, talk to your tax person, kind of stay in the loop on what's going on. Obviously, listen to podcasts and webinars like these. And because once something changes, then it's okay. Well, what changed? What affects me? What can I do to kind of take advantage of this, right?
Mm-hmm. Yeah, and obviously keep updated with your CPA on what your plans are, so they can also help you adjust as necessary. Something really important to understand is, in the unlikely event that President Trump doesn't make these tax changes that we are anticipating, a lot of the tax benefits that were reenacted as part of the Tax Cuts and Jobs Act is expiring as of the end of this year. And what that means is taxes will go up significantly for a lot of Americans. And so to keep that in mind, right? We have the two extremes, like something changes that happen, probably going to be beneficial for real estate. If no changes occur, the natural change will be higher tax rates and elimination of some of these tax perks that currently we get as business owners and real estate investors. So it'll be an interesting year for sure, in our world at least.
And all those are set to sunset in 2020, at the end of 2025. So we would see this like in the 2026 filing season, right?
Yes.
If not. All right, well, we have several questions that are, accumulating in the QA box, in the chat box, guys. If you have a question for our guests, make sure to put it in there. We'll ask those in the Ask Me Anything part of the show. But I want to make sure that we wrap up here. For those listeners that are listening in on YouTube or our podcast, what do you see are some of the biggest mistakes that passive investors make? And what is one key takeaway that you want everybody to remember from this conversation?
I guess let me touch on one of the mistakes that comes to mind. I think is that passive investors make is they don't. I guess what's the way to they don't remember where they invested the money from. So I guess they think they invested with with their personal name and personal funds, and then they get a K-1 that says some LLC name on it or their S corporation name on it or something, And so that would be the mistake I see people make, is that they don't. They haven't taken a good inventory of what their investments are. So, making sure that, yeah, this is supposed to go on that return. This is supposed to go on our 1040 versus my partnership return. that's one we see a lot. So that's just a matter of kind of reviewing your documents and making sure you've, crossed all your T's and dotted all your I's.
I think a common mistake I see is just making sure that your tax person is kept in the loop before you make the investment. A lot of times, they don't even know you've made the investment until they're doing your taxes, or even worse. Sometimes, I mean, we've seen investors where they have so many investments that they kind of forget, and lots of K1s.
That never happens.
And sometimes you file a return and later it's like, oh, there was another K1. I kind of forgot about it. So, just have an idea of what you invest in. I mean, not just for tax purposes, obviously very important so you get the tax benefits, but just, as a wealth building thing, right? You want to know where your money is and how it's doing for you. So treat it like a business, even though we say it's passive, but, do kind of still make sure you have the due diligence on the deals and that you're monitoring to see if your money is actually working for you.
Yeah, I think approach it like just the man said, approach it like it's a business, right? You're investing your hard-earned money. You want to keep an eye on it. What is it making? What is it doing? And then, have that open conversation with your tax person throughout the year. Don't wait until April 1st to drop information on them and say, this is what I did last year. Like, what can you do to help me last year? Well, there might be a few things, but there's going to be far less things than if you were proactively planning throughout the year, right?
Well, then I think that leads me into that kind of the round out question for the show. What do you want people to actually take away from this conversation?
Yeah, like I said, I think just don't think of it as just you're a passive investor. Again, approach it like it's your business, right? You are investing in whether it's real estate you own directly, maybe you're investing in somebody else's syndication deals. It's all your money. So if you approach it from that business mindset, I think you're going to be much more successful than somebody who doesn't.
And I would say just understand that real estate comes with tax benefits regardless of what capacity you're investing in. And it's all a timing difference. If you're purely passive and it's not offsetting W-2 income for tax purposes right now, that's okay, because at some point in the future, the goal is you're going to generate passive income, at which point you can use these losses against. So there's always a benefit. It's just a matter of when can you benefit and what type of income you can offset in any given year.
Well, Matt and Amanda, thank you so much for joining us here today. We're going to open up our Ask Me Anything part of the show here in a minute. But for those listeners who are listening on their favorite podcast player of choice or on YouTube, what is the best way for them to reach out to you?
If you're looking for additional tax strategies as it relates to real estate, I also have a YouTube channel as Amanda Han CPA. And if you're just looking for daily tax tips, the best place to find me is on Instagram, also as Amanda Han CPA.
Yeah, and then also our website, we have a lot of great information and resources on there, so people can check that out at KeystoneCPA.com.
Awesome. Well, Matt and Amanda, thank you so much for joining us here today. Guys, if you're live, don't go anywhere. We're about to start the Ask Me Anything part of our show. All right, so kind of starting off at the beginning, a question from the beginning part of the conversation. Since bonus depreciation is phasing out, can you explain how a 5-year exit would work as far as depreciation and recapture on an exit?
Yeah, I mean, it's not so much that planning for the exit is not so much that bonus depreciation is phasing out per se. It's just a matter of looking at kind of what did you take depreciation on the investment? Was it 5-year assets? Was it 15-year assets? Was it the building? And then kind of play out that 5-year holding period in terms of when you sell it, what's going to be the potential sales price. You may have to allocate some of that sales price to the things, the 5 and 15-year assets if you took accelerated or bonus depreciation. So there may be some recapture there, but that's kind of what we were talking about earlier, right? The longer you hold, the much better argument to say, hey, that 5-year property that was, worth $100,000 5 years ago, it obviously didn't appreciate in value because it's a bunch of furniture and fixtures and things like that. So there shouldn't be a lot of depreciation recapture on it versus if you only held it like 2 years. Easier argument for the IRS to make in that situation, right?
All right, and I know we have a lot of people that are putting in questions about their specific real estate situations, and I'm going to make sure you guys need a CPA, you need an accountant, you need a tax strategist. So we'll direct all of those questions back to your specific account, because there's so much information that Matt and Amanda would need to be able to answer your question. But kind of continuing on with some of the more general questions, is it normal for the syndicator to not send out K-1s until early April? All the 1099s are due January 31st, but late K-1s are tough.
Yeah, unfortunately, that's sort of comes with the syndication space. It's not uncommon to get the K1s in April, or we have a lot of clients who just know it's coming after April, so sometime in like the summertime. And the reason for that is syndication tax returns are a lot more complicated than a 1040 return, depending on the syndication you're involved in. A lot of times there's many investors. If it's an open fund, there are a lot of properties across multiple states. So yeah, not uncommon. I would just suggest that if you're gonna, if you have a K1 that's coming in super late or even afterwards, make sure you file extensions on your personal return or your LLC return so that your return is not late. And if you owe any taxes, all you have to do is just make sure you pay the taxes by the due date. In fact, for the majority of our clients, we actually recommend going on extension, even if they have everything. Part of the reason is because we do what we call multi-year tax planning. So if I file by April, I know very little about 2025 because the year sort of just started. I also don't know if the administration will have any tax changes in 2025. But if I file extensions, now I'm waiting and I can file as late as September or October. By then, I have a really good idea what my 2025 transactions were, what the 25 tax law is. And that knowledge might impact how I choose to file my 24 taxes.
Yeah, I would 100% concur with that. And just to kind of stack on a little bit here, I think a lot of limited partners don't actually realize that the tax filing deadline for 1099s is January 31st, but business returns typically, if they choose not to file the extension, is not until like correct me if I'm wrong, like March 15th or March 30th, right? So even just if you have a syndicator that is filing like, on time and not pushing an extension, those deadlines actually come in March, not in January.
Right, exactly.
Yep.
As an LP in a syndication, how do I know to take depreciation on the investment? I didn't see any line item for depreciation on the K1s I received.
It's a great question. So you're not going to see a separate line up for depreciation because they are doing that already inside the syndication tax return. So when you get the K1, it's net of, it's rental income minus expenses, whatever, minus depreciation. So that's already factored in when you get your K1 number.
Mm-hmm. And that's another benefit of being a passive investor is you don't have to worry about it. The sponsors already did all that for you. So you don't have to worry about, like to do one and pay for it. It's already done.
Yeah, and also they also completed the cost segregation analysis, which is expensive, and time consuming for properties as well. Can you discuss the conversion of a traditional IRA to Roth IRA after investing in a passive real estate investment and how discounting works and how it can reduce the taxes you pay on conversion?
Yeah, and so anytime somebody's looking at moving kind of money from their pre-tax retirement account to a Roth bucket, you haven't paid tax on it yet because you probably got a deduction you put in your 401k or something, right? So and it's grown from there. So when you do a conversion, whatever the value of the asset you're converting is going to be including your income. So to this question, right, the idea is, okay, I invested in this syndication deal. Maybe I put $100,000 into it, but the question would be, what is that worth on the day of my conversion? Is it worth $100,000? Is it worth something less? Because, excuse me, maybe the deal is kind of not cash flowing yet. Maybe there's an argument that there could be a discount there. Maybe, you've got a small percentage of the company, so it's not, hey, the real estate itself is $10 million, but I own 0.013587% of it. Like, what does that number look like in reality, right? So you do have to figure out what the value of the asset is that you're converting. There's a lot of flexibility there, I think, in terms of something like this. Definitely something you would want to talk to your advisor about before you do it, because you'd want to time it in a year where it can make sense from a tax perspective for sure.
All right. So for SDRA investors, how do you handle filing K1s for an investment that may incur UBIT? Is it a separate tax return form or a separate tax return for your SDIRA?
Yes, yeah. So the tax return for reporting UDFI or UBIT, usually it's separate from your personal taxes. So the IRA itself files that tax return, and then the taxes, if there's any due, are paid from the retirement account as well. And that's also a good point, just since we're in, kind of the start of tax season, is if you have used your retirement money to invest in real estate, IRA, Roth, 401k, you get a K1, make sure to send it to your tax person. Don't assume because it came from your retirement account investment that you don't need to do anything with it.
I like how Amanda's smiling. She's like, please send it to us.
Then just
Yes.
don't put it in the shredder.
Because sometimes we're like, oh, this is new. And it's like, oh, no, you've had it for 3 years. Great.
Yeah. Based on your client's experience, how difficult do they find it to prepare several state income tax returns when you invest in a passive real estate investment that has properties in various states?
Well, for our clients, they don't find it hard to prepare those at all because they don't prepare them. They leave it to us. But yes, it is something to factor in when you're investing in multiple states. Every state has their own rules. Generally speaking, if you have owned property in a state, you're probably going to file a tax return in that state. Now you may not have to pay any taxes, right? Some states have an income threshold if you only make $1,000 or more, things like that. But it's something definitely to factor in. Some of our clients choose, hey, maybe the exposure is minimal. I didn't make any money, and there's no minimum tax, there's no penalty. I'm going to pass on filing there. Sometimes clients want to file there because maybe they have a loss and that state will allow you to carry the loss forward. So that if and when that asset sells in the future and you've got gain, you can use the carry forward loss to offset the gain. So that might be a reason to file, but it can definitely add to the cost, obviously add to the administrative thing of keeping track of your tax returns for sure.
And sometimes the sponsor will just file the composite return, so that
true as well.
You as the investor don't have to file. So that is also a great question, when you're looking at what syndication deals should I invest in? Like what state are we in? And then which returns are you going to file composite for me, or do I have to follow them myself?
We got time for 2 more questions. One, do you feel it's always better to convert traditional IRA to Roth when able to pay the tax, or are there reasons to not convert to the Roth?
Yes, I mean, it's never a one size fits all. So just because you have the cash to pay, I don't know that would mean you should make a conversion. So you have to take a look at a lot of different factors. One example might be, even though I have the cash, but I'm still in a higher tax bracket, and maybe I don't want to convert, right? Typically, I want to convert in a year where I'm going to pay very little or no taxes. So for some of our clients, it's at retirement. So they, at retirement, when they finally don't have that high W-2 income, some income from retirement accounts, that might be a good time to convert. If you also happen to have a lot of real estate tax benefits to offset some of that conversion. So yeah, it's not an always convert type of conversation.
Yeah, it really does come down to kind of looking at planning and like, where are you at now? Where do you expect to be in the future? What do you have going on in your situation? When's the right time to do conversion? But in the right situations, for sure, it can make sense.
Well, Matt and Amanda, thank you so much for joining us today and sharing your knowledge and expertise with us. I'm going to close out with this question. Where can someone find a good tax planner or CPA? And let's answer that across the United States, but also if they're looking for somebody local, how can they do that?
For real estate investors, generally, what's more important is that you work with someone who understands and specializes in real estate rather than someone who's local. Why? Because most people invest not just locally. So you could be someone living in California, but also investing in Tennessee and New York and Ohio. And so if you have a local CPA who doesn't understand multi-state taxes, then you also have a problem there, right? A couple of good tips on finding the right CPA. I think just asking good questions. Don't ask them, hey, do you work with real estate investors? Because 10 out of 10 will say, yes, I work with real estate investors. I have one investor client. But you want to work better questions, like tell me what your successful real estate clients are doing, right? Get them to talk and you get an idea what kind of stuff are their successful real estate clients doing? And is that kind of the goal that you want to build towards?
Yeah, and I would, reach out to people in your your circle of influence, right? Like, you know, who are they working with? If you're talking to investors who are investing in other states, who are they working with? Because, you know, obviously today's day and age, you know, we work with investors all over the country, right? Other people can do the same thing. So it's not, I don't think you have to be stuck by somebody who's local, but again, you want to find somebody that understands what you're investing in, because, you know, we focus on real estate. I couldn't help you if you have a retail business or a manufacturing company. I don't know anything about that, but we know real estate though. So
Awesome. Well, guys, thank you so much for spending your time with us here today. We look forward to having you back on the show. All right, guys, I am going to encourage you, if you're still here live, still listening to us, and you need a tax strategist, please do not email me and say, who should I hire? This is the reason why I brought Amanda and Matt on. They are some of the most trusted people in the space. So don't email me that. Reach out to them, guys. All right, take care.